Welcome out to Trading Justice episode 594. Joined with my brother Matt. This is Mark Justice, and we're going to talk a little seasonality. Now, it was funny. I talk to my brother all the time, and we were just shooting some market jargon on Friday, and I was just like, well, my base case for the market, and I laid it out. And my brother Matt said, that sounds like you're following seasonality this year.
Pretty much.
And he's like, wow, Mark becoming a seasonality guy. Because Matt and I haven't always traditionally been the biggest seasonality guys. We think there's some easy fallacies that we'll discuss, but we're going to talk about seasonality. And we're specifically going to talk about September seasonality as we turn the calendar page into September. We're going to go over some interesting technical setups in the market. We're going to talk about some interesting news and stocks, including NVIDIA's earnings. But we're going to have a good, enjoyable podcast for you, brought to you by Tackle Trading. Go sign up for that 15-day free trial. Come join Matt and I on the lounge on a daily basis. But Matt, how are you doing as we turn to the month of September?
Doing good. Excited to be with you for another edition of the pod. And man, the market's knocking on the door of a breakout going into some, it's a fascinating market. The market is in a multiple time frame breakout situation. It looks really, really, really good on that breakout, and you're going into September seasonality, which is historically the worst month of the market. So do you anchor against your technical read, or do you anchor against a historical understanding of seasonality? Let's discuss in today's podcast.
You just summed up the debate, and let's talk about that technical setup first and foremost, because Matt, like I've done my own separate studies over the last couple of years. These longer consolidation patterns, you go back over the last couple of years, the longer these go into more than just 10 days, they break bullish. They tend to break bullish. It's like, all right, bears, we're trading sideways. Here's your shot. And when they fail to do so, it's like, well, let's go test to see how we go higher. Pretty clean setup as we enter the first week of September, isn't it?
Yeah, it is. It's a very clean setup as we do enter that first week of September. We've gotten exactly what we asked for in the consolidation after the V-shaped recovery from earlier it was about mid-August. We saw that V-shaped recovery all the way through the end of September. And then as you did get back up into that all-time high, you didn't just break and run. You formed a little bit of consolidation. And that consolidation, in my estimation, goes a very long way. As you're absolutely right, it not only alleviates some of the overextended condition from a pure technical perspective, but from a behavioral perspective, you're like, okay, bears, you had your shot here, you had your shot there, you had this data point, the market tried to break, and the market just could not find any desire to sell off here. Every time we saw any intraday move to the downside, it got gobbled up throughout the entire week. It could not break that 9 EMA, which obviously caught up to the price action this week as well. And then how many times have we seen in the last few years, Mark, whether we're talking about a sector, whether we're talking about a stock, whether we're talking about the index itself, where the market gets a little bit overextended, separates itself from the short-term moving averages, and then consolidates while that very important 9 EMA catches up. And then as that 9 EMA catches up to the price action, all of a sudden the market now has a tendency to giddy up and go again. And so that's kind of what happened this week. We had a tremendous amount of news. We'll get into it here in just one second, but you had a tremendous amount of news and you did not see any additional volatility. And then on Friday of this week, you and I, Coach Gino, Greg, Frank, we're all kind of sitting there in the scouting report meeting on Friday, and we're sitting there about an hour before the market closes on Friday, and we're sitting there debating the rankings, for example, and we're talking about the S&P 500 and the RSP and the Qs and IWM, and we're looking at all the different indexes out there, and basically we're just sitting there going, well, it's kind of a doji fest, right? It's a doji fest. But then on Friday, right before the close, you had these buyers come in fairly aggressively with big ticks in volume coming in, pushing all the way up into that breakout channel. And so, yeah, the Friday close coupled with the defensive posture the market had last week, played defense all week long. Friday close, you came in with those buyers. And finally, one last thought just here from an overall volume perspective. volume has been less than average over the course of the last
This
2
is a
weeks.
good point you're about
Right.
to make. I even missed this in my own analysis. This is a good point you're about to make.
Yeah, volume is a measurement of participation, right? And it doesn't really tell us anything other than a measurement of participation. But when you couple the volume with certain technical situations, it can give you a pretty good secondary confirmation. And when you're talking about a pullback, for example, when you're talking about a higher high and then it starts pulling back to a higher low, you want to see volume come down. You want to see volume reduce a little bit, showing you that you're not seeing an aggressive type price action. You're not having an aggressive type conversation. It's really just about profit taking. The traders that have driven the stock up, they're now locking a little bit of profit on the way down. On a breakout, what you want to see as the stock is attempting a breakout is an increase in volume. And we got that on Friday. For the first time in a couple weeks, we got that. And so as we navigate this potential breakout next week, it's going to be very important to not only look at the ability to see a close above that 565 level, which is currently the resistance level on the S&P, but you also want to see the volume bar, which we saw expand on Friday. You want to see that expand coming into the week as well.
Yeah, no, there's one thing I want to highlight before we go look at some other charts that you said. You got what you asked for.
Yeah.
Right. Because, all right, market sells off. You have the carry trade fiasco with some growth worries and not a message from Jay Powell on that last Fed meeting. It caused some market, volatility. You came down, you started to V-shape, right? And then you were strong. And then traders will say, oh, this is BS, like V-shape and that. And then you take 2 weeks off. You don't have any excuse at this point, right? You are given plenty of time now and heading into the coming week, right? A whole Labor Day weekend to prep any new trades that you want to do ahead of a potential breakout, Matt. I mean, so you were given what you want. This is an excellent call out on the volume on Friday because, one of the things that also many bears have pointed out at previous rally, there's no volume on this rally. There's no volume on this rally. In fact, go look at the last rally at the 1st of July, right? A move up, not a lot of volume. Friday was a very, very telling day on multiple things, Matt, because you were at a level Friday, a couple hours into the market where you could have easily broken support. Right, you were down at support. You were right there at the 90 EMA. You had traded sideways. It would have been very easy for the market to break down, go see what that 20-day moving average feels like. And it wanted nothing to do with it. Going into a 3-day weekend, how many times have you heard traders over the years say, like it's heading into the weekend, I don't want to take risks.
Going into the last hour of the market, that was my mentality. I was like, okay, this market might be done here, and all of a sudden, you and Greg are geeking out. Oh, nope, but the market's not done here. It's not done. It's up, 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 up. So it was a really fascinating close. You made a point that I just want to add something to. The bears out there that say the V shape was ridiculous. It was a little bit ridiculous in terms of the upward movement in price following that violation of support and the pretty aggressive drop in price. Mark, a lot of that was driven both in terms of the 3-day downward movement in price and the 7, 8, 9-day recovery price. So it took 3 days to drop, took about 8, 9 days to recover in terms of the drop in price. That was all based on the central bank and what the central bank was going to do.
Isn't it funny that a 3-day drop in price isn't ridiculous of the same level, but the
8-day rally is it's kind of it's funny when you think about it. I mean, the way I see it is, yes, was the V shape a little out of control in terms of how many days it went up without a pullback? Maybe a little bit. But in essence, Mark, from the drop in price in late July, early August, to the recovery throughout all of August, pretty much, you really didn't see a fundamental difference in earnings. You really didn't see a fundamental difference in the economy. You really didn't see a fundamental difference in how the central bank is going to be going out through the September cut. Mark, from the last time the Fed spoke to us to Jackson Hole to today, yeah, it's been a volatile conversation, and the markets have been certainly volatile in terms of the V-shaped down, V-shaped recovery. But in essence, Mark, has anything changed?
We're having about the same general conversations
And
that
we're
we've had
still
for a while.
debating around that 0.25 versus the 0.50 cut in September. And so I guess I just see it as, you recovered the fell drop, and then you had 3 additional days up before you got into consolidation. I see this simply put as just a very simple breakout type situation where resistance is challenging to break. We have not officially broke out yet. The breakout channel is at 565. But Mark, if you see a breakout following consolidation and you're breaking out on increasing volume, I don't know how any other way to describe that than a bullish scenario.
Yeah, no, I did a little front running of the breakout on Friday. Based on what I was seeing, I loved the intraday bounce that occurred on Friday. You came down to a multi-day support level and you bounced pretty clean. And then as we break out, I will do a series of short-term trades. Now, short-term because I do worry about seasonality. We'll have that conversation in a second. But I feel like I got a couple week window, Matt. I got unemployment week this week, right? Unemployment data comes out this week as we debate oh my goodness, will we have a recession or not? And I've gotten the biggest kick out of Goldman Sachs swing trading the recession odds, seemingly with every economic data point. It's like, that's economic. We better raise them 5. We better lower them 5. Needless to say, we're having the same conversation. There's some worry about some stagnant growth, right? I think that's pretty, does that lead to something more severe or does it not? That's kind of the debate in the marketplace right now. And we get a very important piece of that this week. And then the week after, we have CPI report, which I think we can put into the probably as uneventful a CPI report as we've had in years. And then we have the Fed meeting the week after. So I think there is like a 2.5 week window here that if you break out, very constructive fundamental, very constructive technicals. And as long as the fundamental story doesn't get in the way, right, I think you got a window for some bullishness here. The fundamental story getting in the way, Matt, like what would be some scenarios this week where that fundamental story would get in the way of a nice technical story developing?
Well, 2 things. Number one, it's the market's in a really, really, really good breakout type situation. There's no doubt about that. However, if we do not break out and we do start pulling back, I just want to give one level to keep an eye on. The 550 level on the spiders is a really important level. It's right where the 90 MA on the weekly chart is. You also got the cluster of the 50 and the 20 period moving average right around 550 as well. So if we do start pulling back next week in the labor week, you do have a lot of support right around that 550 level, and I do think that would look pretty good going into a little bit more of a cup and handle type feel going into that 560 breakout. So 565 is the number on the breakout channel, 550 is the number on the pullback type scenario here, and so you're really working that range.
Well, a pullback would be messy to play though, wouldn't it? Like
it would be messy to play if it pulls back over 2 days, V-shapes right back up into 565. That would be difficult to play, but again, that's kind of the scenario I'm seeing right now from a pure technical perspective. Now, Mark, you asked the question, is there some scenarios out there or what is some scenarios out there that would mess up the breakout channel?
Yeah, right? Because and let me preface why I'm asking that. Because let's say we have assuming inflationary data, and if you'll just fast forward to the week after this real quick on Forex Factory, and then we'll come back just to show that there's not much going on like the next week. Like, there's basically, you have a couple inflationary reports that if I assume that those will be basically in line, non-narrative changing, right? It's this week is the week that it could provide any hiccups to that. And like on the one, like, let's say jobs come in a little softer. Well, that might mean we get a bigger hike. But as you've pointed out last week and in the newsletter last week, negative economic data might mean more cuts, but it might spook the market more. If you have But is that the scenario to hiccup what could be a couple positive weeks to start the month of September?
The only way I see a good news is bad news or bad news is good news, environment this week is if the market's having we're going to throw a fit if we don't get a .5 cut type scenario, which
I don't think that's the mood of the
I don't think
market.
so either. I think they're just okay. We're getting a cut in September. I think we're in let's just look at the data coming in because I think the most important part of this conversation in terms of where the central bank is and what Jay Powell said at Jackson Hole is on the labor side. If labor continues to deteriorate, that's going to be a negative sign regarding cuts because the way the market's going to see cuts is the logic behind the cuts has to play a role here.
Yeah.
And if the logic behind the cut is we're simply alleviating it because labor's fine and inflation's coming down, then you're simply alleviating the over restrictive territory of monetary policy, and thus you're just talking about a similar situation of 2018, 2019, or 1995, 1996. Versus if you're going into a cutting cycle, which we obviously are, we're going into that cutting cycle and the economy starts to deteriorate there, then the data suggests that this is a negative move from a cutting perspective because the cuts are to stave off an economic recession. And so in my estimation, labor market data becomes chiefly important in this conversation. And bad news on the labor market is going to be bad news on the cuts, in my estimation.
I
Good
think
news on
so
the labor
too.
market is going to be good news on the cuts, in my estimation, because we're getting cuts. That's not
So your base
debatable.
case here is a bad news is bad news, good news is good news. Straight up. Just straight
On
up.
labor, absolutely 100%. On CPI, that's going to be. I need to see where the market's head is at regarding labor markets before I even get into the CPI report. But the Fed told us this just last week at Jackson Hole. We are shifting the balance of risk to the economic side. They have basically declared victory on the inflationary side. And like I said last week, whether or not people in America see that as how are you declaring victory on inflation when we're still having an inflationary conversation? Remember, there is tremendous lag to the
Because
inflationary
we've accepted
conversation.
3%.
Because we're at 2.9% and they're concerned about labor. So the Fed told us to be a little bit more concerned on the labor side, less concerned on the inflationary side. That to me doesn't necessarily mean I shouldn't be concerned about inflation. I'm a big gold guy because I think the Fed's wrong on that conversation all the time. But we should focus on the labor side of the equation. And to me, I just think we're in a good news is good news, bad news is bad news because we're trying to understand the purpose of the cuts. And the purpose of the cuts, I cannot tell you how important the logic behind the cuts is going to play out because if the economy stands strong in terms of GDP at 3% right now, labor's at 4.3% right now. If labor does come down to 4.2% this week, as is expected in the forecast, and you saw GDP at 3% last week, labor at 4.2. Let's say it comes in
And
line,
let's say those
4.2.
ISM manufacturing services come basically in line.
Yeah.
Let's say they're a non-factor.
Okay. Then I don't see how you would see that as not a positive.
Oh, the SPY's going to 575.
Because if the economy's not going to crater and labor's going to stay in this 4 to 4.5 range, and it's not going to puke up circa what we saw in 2008, 2009, you're going to go into a cutting cycle where you're simply alleviating the restrictive territory so that you can increase the economic activity. That is a really positive backdrop for stocks,
it is.
quite frankly. On the flip side, if labor implodes and the Salm rule, triggers a recession, as we discussed a few weeks ago, if labor continues to go down, I don't see how you don't see that as circa 2008 or 2001 or 1987. You can't see the cutting cycle as positive or negative yet, in my estimation. That's why I feel like the pure technical read is probably the strongest read right now. But in the back of my mind, I am more concerned on the major economic reports than I am on the major inflationary reports. And quite frankly, the reason that is the case is because what the Fed said at Jackson Hole #1, but also my understanding of this conversation and cutting cycles that goes back 25 years. It's not a guarantee. It's not a guarantee that markets go up simply because rates go down. The economic conversation becomes chiefly important in that moment in time.
Yeah, no, and so my basic plan coming into this very important data week, because like I said, I don't think we have, like, I'm not worried about inflationary data as far as a narrative changer next week at all. And then we got the Fed meeting after that. And so we got this like narrative formation possibility. So if data comes in generally in line, that's a positive for I think risk assets as a whole, right? And I certainly for equities, which I do think they play the technical breakout here and then find how high they want to go in the short term before seasonality and the Fed meeting get in the way.
And we'll see if seasonality plays any role in that conversation. But I do think it's important to understand the seasonality of September and October specifically.
Yeah, and then if you beat, and if the labor data this week deteriorates, well, I can tell you my allocation to gold will increase. My allocation to bonds, I don't have any bonds right now, might do something there. Like if it's really, really poor, and be less interested in equities, just straight up. And the equity plays I am interested in are going to be like healthcare, biotech, those type of things that maybe aren't as tied to the economic cycle. But what happens, and I don't have a really good playbook, let's say that non-farm unemployment change comes in at 250 this week, right? Let's say it has a remarkable beat. That is the one. I know what I'm doing in scenario A. I know what I'm doing in scenario B, but I don't have okay, good news is good news, but what if it is really good news?
I think the algorithms would have a volatility action, and I think it would make us all question that data.
Well, yeah, I'm not going to believe it, but will the algos believe it?
No, I think you would have an algorithm move, but an algorithm move cannot create a sustained move. A sustained move you have to have people participating in. And so, yeah, the first 15 minutes of that report would be chaos. It would be chaos from an algorithm perspective. But I don't think that would be a sustainable move. I think the market would eventually sell it because we're too fresh against 18. Quite frankly, we're too fresh against 12 out of the last 13 months getting revised downward, and we're too fresh in terms of 818,000 jobs getting revised out of the labor market number over the course of the last year. So on a sizable beat, I think we would inherently question the data as well.
Yeah, it's one of those things that, like, if we have a sizable beat, my plan literally is to meet with you for an hour and a half, and then we put out the tackle today with what our analysis is, depending on what we're seeing in algo price movement. But assuming we get somewhere in line of chalk, Matt, I think, let's go back to the charts here.
Data in the last week and a half has been closer to chalk than we've ever seen.
Isn't it so chalky?
Ever since the 818,000 job revision, it's almost like somebody told somebody somewhere, you better be more accurate on the data. Double check, triple check before you put out those reports, because they have been more accurate in the last week and a half. There's no doubt about that.
Yeah, so let's go back to the chart.
I would be a little surprised on an outlandish.
Yes, I would too. That's why I don't have a plan prepared for it, to be honest with you. I'm pretty much giving the bulls the benefit of the doubt for the next couple of weeks. And as long as I see non-implosion of data, which is a safe bet because most of the time data doesn't implode, right? That's not an outlandish expectation. And I see technical consistency in major indexes, I'm prepared to approach these next couple of weeks from a pretty bullish standpoint. And it sets me up for a lot of dealer's choice, right? Because I got a lot of, I only got so much money, right? Because I don't care if you have 100 million or 10,000, you only have 100%, right? I'm not going to allocate it all, even on a short-term basis, to equities, right? But I got a lot of choices in charts to make trades up, right? I can go straight index, right? Be the coward like I usually am. Certainly will do something on the SPY because it's the easiest. But man, I got a lot from small caps to biotech to technology itself, to semiconductors, which, and I certainly want to take a look at the semiconductor chart. I got a lot of charts that I could make an argument for from a bullish perspective. I'll break some of these down for us.
Yeah, when you're looking at the indexes, I really don't have a massive take on one index versus the other indexes. They're all kind of running a little bit on the same gasoline right now because we're having quite frankly, a V-shaped recovery followed by a macroeconomic monetary conversation. And when we do that, a lot of times it will realign the markets, and the markets are kind of running on that same gasoline, although we are seeing a little bit of relative outperformance versus underperformance in this V-shaped recovery just over the course of the last week and a half, 2-3 weeks. When you're looking at RSP, whenever you look at RSP versus the SPY, you're trying to understand just from a macro index perspective what areas of the market are doing good, quite frankly. When the SPY is doing better than RSP, that tells you you're having a Max 7 technology aggressive growth-based conversation because of the weighting criteria of the S&P 500 when it comes to NVIDIA, Amazon, Meta, Google, Amazon, Apple, right? Those Max 7 high-flying components out there, they're not equal weighted in the spider, so that when they're doing really, really good, the top of the market, for example, well, that's going to reflect in the trend of the spiders a little bit more than when you're looking at the equal weighted index, the RSP. And when RSP is doing a little bit more consistent from a trending perspective, that typically shows you that you're seeing a little bit of relative outperformance on specifically the Dow Jones components, cyclical areas of the market, also on the defensive side of the equation, such as the consumer defensive areas of the market, or utilities, real estate, so on and so forth. So RSP right now is looking a little bit better from an overall trending perspective and a momentum perspective than you are seeing in the SPY right now. When you're looking at the Qs is going to show you that relative underperformance here a little bit as well, because, and again, some of this is because of the strength of the previous trend was really, really, really good for tech, and the sell-off was really aggressive to the downside on tech. And so visually, you're not going to see it as much in terms of the V-shape, because on RSP, the V-shape went all the way up above resistance. S&P's V-shape went to resistance. Well, the Q's V-shape actually came underneath resistance. That's because of the aggressive sell-off in the Q's. The performance I'm talking about is in the pattern development over the last week and a half, where you're seeing a high base momentum trigger on RSP. You're seeing a multiple time frame setup on the SPY, and you're seeing a flag based pattern here on the Qs. They're all bullish patterns.
Yeah, I mean that's the dealer's choice, right? It's like,
yes, they're all bullish patterns. They're just a little bit different. Do you like the flag-based performance pattern on the Qs a little bit, where you have to navigate a little bit of the challenging overhead, or do you like the cleanliness of the momentum of the RSP, or do you like the multiple time frame of the SPY itself? However you want to look at it from an index perspective, you're looking at the beginnings of bullish trend analysis, and that's why there's a lot of dealer's choice, is because is this, for example, on the Qs, is this pullback we're seeing to 470, is this the first higher low in a trend? That's an open question, obviously. Well, that's what we're currently seeing here. So if that gets confirmed, well, historically, yeah, that would be the beginning point of a trend. When you're looking at it on RSP, even the high-flying momentum areas of the market, remember, once you give up support in the previous trend is over, which means the current movements you're looking at over the last 2-3 weeks in the market, they're all the beginning point of a trend, is what they're the beginning point of. And so you're looking at a high base with momentum on RSP, the multiple time frame on the spiders, or the flag base pattern on the Qs. There is a lot of dealer's choice out there. There's no doubt about that, Mark. Whether you're looking at defensive areas of the market with a little bit of overextended type scenario, where you're looking at beginning, the early beginning, indicators of a trend within the Qs. It's really just dependent on who you are as a trader, what areas of the market you want to focus on. But I don't have much to say in terms of, in terms of, this index is running really, really good against that index. There's a general bullish feeling in the price action right now, and it's reflected across the space regardless of the index. And that should tell you, number one, when all the indexes are kind of doing a little bit of the same thing, you're having a macro conversation. And that macro conversation is obviously based on the central bank pivoting, the official confirmation of the pivot from last week, and now we probably start to see relative outperformance as we start to navigate this week, in my estimation.
Yeah, absolutely. And so it's going to be really interesting. And we're going to do our best to navigate our community at Tackle Trading in the Traders Lounge through our traders reports with what individual setups, what areas on a day-to-day basis. But a lot of choice. Like, I'm not normally a biotech guy, but I love biotech charts right now. Just one example of like all of the many areas underneath, right? There's a lot of things you can make a case for. You can't trade it all.
The
But I
reality
will be.
is, if you love reversal analysis, there's reversals in the market playing out right now. If you love mid-tier breakouts, there's mid-tier breakouts in the market right now. And if you love momentum analysis and growth analysis, there's plenty to be had out there right now as well. And so when you say dealer's choice, it's not just based on a space perspective. It's not just based on a sector. It's not just based on the industry. It's the positioning on the chart as well.
Yeah, absolutely. I'm going to give you an example of one of those when we talk about five stocks in the news here coming up here in a few minutes. But before we do that, let's fire through commodities. Let's go look at the dollar first and foremost, or we can start with gold. I think the dollar tells us maybe some of the causal things. We saw an oversold bounce this week. I don't think it's more complicated than that, right? Came down to that 100 level on the general dollar index, got an oversold bounce. It's not more complicated than that right now, is it?
Technically, no, it's not more complicated than that. But again, to describe it that way is 100% accurate. But I will say, as you do navigate the depth of this retracement, that becomes important as well. So you could easily just describe the commodities a little bit this week as dollars bearish retracing, and that's going to cap out commodity performance when the dollar goes through a bearish retracement. Would you agree with that?
Yes.
Okay, so in general, I think that's is good enough just to describe it that way. Dollars going through a bearish retracement, that's going to cap out performance on the commodity space. Well, if the dollar pivots here, then you typically get the opposite impact, right? So if we see a doji on the dollar followed by that downward movement in price here, that's going to be a really good sign for the commodity space. So yes, do I think it's just as easy as describing kind of what happened with silver this week on a little bit of the pullback, following good breakout of 30, or on copper showing a little bit of hesitancy against that 4-2 handle, trying to break out of the 50-period moving average, or obviously on gold itself with a little bit of hesitation analysis going into a multiple time frame all-time high breakout. Yeah, I think you can describe the lackluster performance overall in the commodity space this week based on that bearish retracement. Two things with that bearish retracement on the dollar, though, that's going to be extremely important to navigate. Number one is the depth of the retracement on the dollar here. If the dollar gets above 102 mark, I don't think you should be talking as much about that bearish retracement on the dollar, because it could be something else too. Remember, there's three types of reversals. V-shaped reversals is one of them. And when you're going through the V-shaped reversal type scenario, and again, with the dollar, this is not just a pivot point. This is a massively important support level on the dollar as well. And so when you're talking about that retracement here, the depth of that retracement is going to matter here. Obviously, momentum retracements kind of work against the 9 EMA. Standard retracements kind of work with that 20 SMA. And so right now, the dollar got above that 9 EMA. The dollar now is looking like it wants to come into the 102 handle. At 102 is kind of where you see a battle zone on the currency. And so keep an eye on that 20-period moving average on the dollar. If it does pivot back down, you're going to want to look at silver, you're going to want to look at copper, and you're specifically going to want to look at gold in those environments. And so keep an eye on the dollar, because we're tracking that pivot, and that pivot on the dollar is obviously going to have an impact on the commodity space itself, specifically the precious metal and the industrial metals there as well. Now, gold. Gold has, I'm impressed by gold. I'm always impressed by gold. Gold should not be hugging the 9 EMA when the dollar goes up as aggressively as it did. The dollar went up.
It's been the story of 2024, right?
It really has. How many times have we said we've been impressed by gold? On sell-offs, it never does anything too aggressive. On times where you think you're going to retrace, you don't. It just has a really good, consistent feel to it. You got to like gold. Now, I will tell you this, Mark. In seasonality, we're going to be talking about the market itself regarding seasonality. Gold has a worse seasonality in September than even the S&P 500.
Bitcoin's terrible too. September sucks for risk assets.
Because when you look at the dollar from a seasonality perspective, the dollar has an edge in seasonality in September. And so the dollar has an edge in seasonality in September. The market has one to the downside. Commodities have seasonality to the downside as well. So that's just something to keep an eye on. I think the average performance over the last 10, 20 years in September is about negative 3% in gold. And like over the last 10 years, it's like negative 1.2% on the S&P 500 itself. And so there is a negative seasonality for gold and commodities in general. That is due more so to the positive seasonality on the dollar. And so we need to track that a little bit, especially the retracement. Keep an eye on 102 on the dollar index, because if it does breach that level, I don't know if you're talking about a retracement any longer. You might be talking about something else at that point.
Yeah, so I'm going to follow that. Other charts in the general, I mean, crude oil's August was just one gigantic candle after another. Some of them up, some of them down. Matt, when this eventually calms down, there's going to be something there. There is. Like when you see a reduction in volatility, but you got to see it first. It was a really volatile month, really wide ranges on the intraday chart with almost not a break at all. It was either big sell-off, big rally, ended lower. We'll see what September brings, but this chart needs to calm down before any. Like even for me as a cash flow trader, I'm like, I appreciate volatility, but then when that volatility doesn't stop, I'm like, okay, let's just break for a couple weeks and see where we're at.
I think this is an extremely challenging chart to even break down, let alone trade, and that's on any single time frame. It's all over the board. It lacks consistency at support and resistance. It lacks consistency and volatility, and in what you think it should do based on news items. It does the polar opposite.
It doesn't care about any of that.
I have zero read here, and I think that's the accurate read here.
I will have a read when we see a reduction of volatility, right? Because eventually, no chart trades with these wider ranges. You never expand ATRs indefinitely. Like you eventually compress them, and when you compress them, you can get a better feel. Bitcoin kind of provided a little bit.
But where the conversations are from the macro perspective, do you see that volatility reducing in September?
If economic data in the United States continues to uptick, I think you're going to see a reduction. I think there was a lot. We saw this from hedge fund positioning. When there was that little growth stare 3 weeks ago, right? Jay Powell, hedge fund shorts exploded, right? Like let's bet on the recession. Positioning got to an all-time low, the lowest, lower than COVID, on those. Let's bet against that. Like if the big bad recession doesn't come, if the data starts to mellow out, if you see a lot of like we've seen in the last couple of weeks, right? Like
I'm with you on that. Like whenever volatility subsides, that's when you see where the true analysis really is. It's just that volatility usually subsides well by now. And you're talking about August, Mark. This volatility has been going on since May.
Yeah,
since OPEC basically said we don't have your back any longer, this volatility has been since May. So tell me when OPEC's going to have your back again.
They're meeting in a few weeks.
I think that's what it's going to take to reduce the volatility.
I don't know if they do have your back. You know, it's along the same lines. If you want to think about those lines about what we were arguing and you specifically arguing about the Fed, right? The markets will once the Fed gives us a path of monetary policy. The other markets will participate. What has RSP done in recent weeks? What has small caps done right? As that path of monetary policy become clearer, markets, not just tech, not just a handful of stocks, but markets. Without that monetary policy, we wouldn't be talking about dealer's choice today.
No.
In equities. And Bitcoin doesn't know what it wants to do. It has zero clue.
No,
It's making
it
it,
doesn't. It doesn't. I will say on not on Bitcoin. Bitcoin had an opportunity to clean up, and then again it just gets dirty once again. Ethereum has a challenging weekly chart here that you could see a little bit of a violation of that 2,500. Keep an eye on Ethereum. It looks to be underperforming Bitcoin just a little bit. I won't have interest longer term on the long term side until we see a deeper sell off here. On the trading side, you're going to have to clean up that volatility, and that volatility has been around forever.
All right, let's get to 5 stocks that I found interesting. This is going to be a new segment. We talk about stocks, but we usually have compressed. But we're going to do a new segment here on the podcast where I am going to bring my top 5 things that I found interesting from a stock perspective. Now, I am more of a macro chart ETF. Individual stocks don't interest me as much. So Matt was like, well, as that, what news stories did stand out to you from an individual stock perspective? I'm going to throw them
I
to
love
Matt.
that intro. I could care less about stocks, but I'm going to give my top 5 stocks. Like,
Yeah, because
ridiculous. First and foremost, that's nonsense. You care as much about individual stock stories as anybody else. You and I talk about them every single day. Get off that high horse. What are you talking
all right,
about?
Nvidia, number one, because I'm not an idiot, right? Like the most important stock in the universe. When it has earnings, it has massive macro implication. It has major index applications. AI, I know we're debating this and we're debating that. AI is going to be a storyline with us for decades to come, even if it doesn't capture all of the headlines on any given week or month period. Came out with earnings, Matt. You were generally impressed, but you also had some like, listen, this is the story arc trajectory, and you talked about this in the newsletter this weekend. Talk about what you wrote in the newsletter.
Yeah,
this weekend.
Nvidia, I think, was obviously the number one stock story this previous week. It was obvious an all eyes moment was Nvidia's earnings, and I did talk about them extensively in the Tackle newsletter this previous week. So if you're a pro member, definitely check that out. For the podcast, I'll just say this: there's not a company in the world that has a higher bar on earnings than Nvidia at this point in the conversation. Everybody in the world was focused on it. Everybody in the world was saying, oh, we're going to get increase in guidance, blah, 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 right? All eyes moment type scenario. It's hard to impress when 122% growth year over year doesn't impress in terms of the market and the market selling the earnings report. I felt like Nvidia's earnings report was a very good earnings report, but it also confirmed some of the concerns that people have in general regarding CapEx spending and the growth potential of AI moving into the future. I didn't feel like Nvidia's earnings report's going to stop the concern, but I also don't think it ends anything we're talking about with the AI side of the equation. And the concern is on the growth side, not the ending of this conversation. I felt it was a really good report, quite frankly. It was one of the better reports in the market this quarter, and obviously that was expected, but they pulled off the hat trick. They had a beat on EPS, beat on revenue. They increased forward-looking guidance quite healthy. They have 75% profit margins right now. If any company in the market had those numbers, we'd be raving about them, but this is Nvidia, and the bar is extremely high, and so the market was not as impressed as it has in previous segments of Nvidia's reporting cycle. But I also don't think it was one of those situations that was like, oh my goodness, I didn't have the read of the market, Mark. I had the read that this was a good report, and if Nvidia breaks out at 130, I'm going to have some interest. Now on the downside,
well, if Nvidia pulls back if Nvidia pulls back, because there was obviously pre-program selling that was wanted right from the get-go. Would you agree with that?
Not only would I agree with that, I wrote about that I talked about that in Tackle today on Thursday. We also discussed that in the lounge. That was kind of my read, Mark, on Nvidia's earnings. The volatility that you saw on the downside on the actual earnings numbers was just on the release of the actual news itself. You really didn't see that following the news, and then it obviously had a little bit of selling behavior on Friday as well. I didn't have a negative read of NVIDIA's earnings. I was impressed by NVIDIA's earnings, and they still are increasing guidance for like the 7th consecutive time. Their revenue numbers are just out of this world, and I just don't believe the CapEx spending next year is going to decrease as much as other people do. I think it's going to actually increase. So we'll see how that plays out over time, but I think semiconductors in general should be looked at in any secondary pattern here.
Yeah, absolutely. And this is one of those that it's just semiconductors remain a very important area of the market. Once again, they can get lost in the shuffle and the different narratives, but this is going to be an area I have started to do some cash flow plays on. We'll continue to look for opportunities to build because I'm with you. I have a feeling we haven't seen the last.
No, we haven't. No, we have not seen the last. But I will say it is a challenging environment, right? Nvidia sold despite positive information. The market is looking at breakouts, and semiconductors technology and Nvidia is pulling back. And so you're seeing a little bit of difference. But if you want to wait for all of that to get cleaned up, just keep an eye on SMH, that's the semiconductor ETF, and wait for a breakout of the 50-period moving average, which is obviously acting as short-term resistance.
My second, and I debated between a few tech companies because we had a slew of technology earnings.
Quite a bit, actually.
With positive earnings. And so I wanted to put one more tech so we could have the cover. Give me CrowdStrike. CrowdStrike's been the symbol of a lot of news headlines over the last month and a half, right? Most of them not good. But as my earning guy, you pointed out something very interesting that on their forward guidance, CrowdStrike said that they had seen a putting off of orders, but not really a cancellation of orders. That's really, really important for one of the cybersecurity leaders here. Talk about that particular tidbit.
100%. They actually made my bullish quick hits list in the newsletter this previous week, and again, it was widely expected to have a negative earnings report because of what happened with the global shutdown due to CrowdStrike just recently. So about a month and a half ago now, we all saw how airlines around the world couldn't fulfill orders, couldn't get things going. A lot of that was due to CrowdStrike, and so there was a lot of anticipation for CrowdStrike's earnings, as they're one of the largest, if not the most important, cybersecurity company in the market today. I think Palo Alto has something to say about that, but it's Palo Alto or it's CrowdStrike. Well, CrowdStrike was, and again, raw numbers aside, it was going to be interesting on their guidance. They did officially beat on the raw numbers. They came in with a slight beat on EPS. They actually had 31% year-over-year revenue handle go up. So decent numbers on the raw numbers despite the chaos from the previous quarter. But I was laser focused on their guidance here, Mark, and they did decrease guidance. They needed to decrease guidance, but in their guidance decrease, it was not nearly as bad as what was expected, number one. And number two, the CEO basically stated that we didn't see orders get canceled due to the outage from the previous quarter. We just saw orders get delayed a little bit, but those are going to be coming back online. And so it looks like CrowdStrike's, I'm certain that there might be some more negative news to it from, what does Delta do, for example? Is there lawsuits regarding this? But from an orders perspective, from an earnings perspective, not nearly as bad as it could have been with CrowdStrike.
Yeah, absolutely. The next one, veering off technology and going somewhere different, is a little bit of a cheat because I couldn't decide, but I want to, number 3 is Dollar General and Best Buy combined. Because this is one of the complexities for me in analyzing the health of the consumer. Is on one hand, we see a company, and this is not the first time this has happened, right? A company saying, we're seeing real challenges with the consumer, right? Dollar General comes out and talks about that, gets a lot of headlines, especially from bears. I follow more bears than you do.
They were very clear on who they were blaming. They were blaming the consumer on their missed on earnings, yes.
Yeah, they were like, it's consumer struggling and this and that. Mm-hmm. And yet you have an entirely different type of company, one that one would argue, if one was being honest and intellectually honest in their arguments, who has higher priced products that if the consumer was struggling might like universally across the board, would not be raising their guidance, was exactly what Best Buy did. Now, we could talk about the consumer and some of these nuances, but I did find this duality here very, very interesting. Talk about it, Matt.
How about Dollar General? You just try to figure out how to do the best you can in this environment because that's what other companies are trying to do, and they don't blame the consumer on your very cheap product offering here, Dollar General. Dollar General has far other issues than just what they were trying to blame the consumer in their earnings report. And take no bones about it, when a company comes out and says our revenues and our sales are down and our guidance is down because of the consumer, they are absolutely blaming the consumer. Now, they might say it's because it's a challenging environment, and it is a challenging environment, but I would think that challenging environment would be beneficial to companies like Dollar General over companies like Best Buy, quite frankly, who obviously are not having that as much challenging environment as, say, a Dollar General is. Obviously, different retail companies, but you would think the challenging environment would hurt Best Buy far more than it would hurt a company like Dollar General. I think Dollar General needs to look internally and not externally on trying to figure out what the problems is with their company, because if they're just going to blame environments, I'm sorry, you can't blame the environment on your company going from 260 down to 82 when the stock market and retail is at an all-time high.
Yeah, no, it is an easy pass, and I don't think if you right now, Matt, with retail companies, if you want to have a bias and not be intellectually honest with yourself, you can go find your argument, right? You can go find stocks that are doing good on the retail side. You can go find stocks like this, say, look, right? But if you were looking at the totality of it, are there issues with the consumer? One, most likely on some level, but it isn't as dire, or else you would not see Best Buy raising guidance.
Again, my point isn't to the consumer. My point is to companies that use information to justify their performance of their stock. I'm sorry, it's these companies' job to figure out how to do the best in the environment. Other companies are figuring it out. Dollar General is not.
Yeah. All right. My next one. Give me PDD. I don't have a huge macro take on this. Now, if you don't know who PDT is, it is the parent company to Temu, right? Now, what is Temu, Matt?
I don't know. Everybody knows Temu. We see their commercials everywhere. They're an online Chinese retail giant.
Like giant, massive, like massive, right? Massive, huge, massive move down. Like whenever you see a stock of this lose the percentage it did in such a short period of time on earnings, it's going to catch your attention. Also give me a chance to talk about China a little bit. Also gives us a chance to talk about if this was Amazon and it gapped down 70%.
Amazon, we'd be market ordering this earnings report.
And I just found, I don't have a great takeaway. I just found it interesting. Do you have any great takeaways? I just found it interesting.
PDD came out with, they beat on EPS. They came out with a really good revenue handle. I want to say the revenue handle was up about 80% year over year. It was a really good number on the raw numbers front. They don't provide guidance, but the way they discussed guidance and the future, it was a little bit concerning. I think in general, this is indicative of what we're seeing in Chinese components right now. They are not being celebrated by the market in any capacity, and I think what we're seeing on PDD reflects more about the current state of market and market participants' confidence in China and investor capital into Chinese components than it does about these actual earnings results, because I've seen some aggressive selling behavior on Chinese components. A couple stocks that are bucking, maybe not a couple stocks, but BABA, bucking that trend a little bit here. But outside of BABA, you've seen it across the board. VIP sold aggressively on their earnings report. PDD sold aggressively on their earnings report. CSIQ, which is not exactly a Chinese component, but we kind of think they are a Chinese component. They're owned by Chinese conglomerate. They sold aggressively on their report as well. And so I've seen in this previous few weeks some stocks that you would feel were not nearly as bad as the price performance suggested in earnings. They have been outlandishly bad, and PDD is certainly right there with it. And so I think it's just indicative of confidence in Chinese stocks in general as much as it is specifically towards PDD and Temu.
My fifth one is Chewy. I don't know if you expected me to say Chewy.
Listen, I didn't know where you were going to go on your top 5 stocks.
You know, but you knew it where I was going after 4. And I bet you didn't have Chewy as my 5th.
I didn't. I didn't. There's a lot of stocks to talk about here.
Once again, because in the midst of a bull market that we've been having for the last couple of years, right? There's been many stocks that have gotten butchered. This has been very much a normal market. There have been times in the past that you've had rising markets and everything rose and selling market, but there's been like some real butchery on individual stock names. One of them was Chewy that just got decimated. And it's a reminder that, like, when you see fundamental stories change or not be justified, because it's not like Chewy had some horrific, it's not like Chewy's Advanced Auto Parts, who have had some really horrific stories and concerns, and you wonder, like, what in the world is going on with that company? Chewy got caught up in in a little bit of what I think bad luck. They're very, very well positioned in the online pet, business, very large name. And so when you see these beat up stocks and you see them come through on earnings, which they have come through the last couple of times, it's a reminder that you don't have to just look at the top of the chart to find good stories.
Like I said, when we were talking about the indexes and stocks, like you want a mid-tier opportunity, you want a reversal, you want a high base with momentum, you can find it in this market. Chewy is a good example of a reversal, a little bit of a longer-term reversal, time duration reversal, and now you're talking about secondary moves following that reversal. I think Chewy looks really, really good above $30.
Yeah, I think this is a nice...
Just one quick point on the earnings. They did report earnings this week. They came out with a pretty good beat against EPS. They also saw good revenue growth year over year. And on their guidance, they reaffirmed guidance at the top, at a little bit of the upper end of the guidance range. I thought Chewy's report was fairly decent for Chewy specifically.
Yeah, and especially if you have an affinity for Chewy, which I do. I think they're a company that's going to be around. I think they do a good job. As a critter lover, you're a critter lover, I'm a critter lover, we love our critters, right? And so you have Warren Buffett style, have a little bit of more of a feel for these type of companies than I might have for other companies that I don't have just that genuine. So I found it to be a compelling story and a very interesting technical chart. Now, Matt, like we talked about at the very start, I got a pretty bullish vibe for the next couple weeks. But as we get closer to that Fed meeting that happens a couple days before September OPEX, I'm probably going to be pulling the brakes because of September seasonality, whether I should or shouldn't. Now, you and I are not the biggest seasonality guys to ever cross the planet.
I don't anchor against seasonality, no.
And I'll talk for a second before we get into the data. And why don't you anchor against seasonality yourself?
Because it doesn't tell me anything about the current here and now.
Yeah, and let me just say the reason I don't anchor against seasonality because it doesn't tell me anything about the here and now, right? It's just that simple. It's like, all right, like seasonality, that's great. Here's all these historical and that. And it's not that we don't look at it, i.e. we're about to talk about it right now. But it's like
having an understanding of it versus anchoring against it. I'm anchoring against a 565 breakout channel on the spiders to increase my bias against the marketplace. That has nothing to do with seasonality.
With volume and with other factors and understanding. And hey, there's a lot of variables that go into any point in time. And when Matt says he doesn't anchor against it, one of the reasons he chooses that language is because that we both have known market participants that have used seasonality as their primary, huge, massive justification, type of guide to help direct them. And it's just not something necessarily.
More so people who use seasonality as a way to sound smarter and try to get people to understand. That's my disagreement with seasonality. It's how it's used and discussed in the market. I think understanding seasonality is extremely important. I just don't anchor against seasonality. It's not my end all be all. But I certainly believe you should always have an understanding of the environments that we are going into. And as we're going into the fourth quarter, October through December, obviously September, there's a lot of seasonality in the next 4 months. And so more than anything, I think it's important to have our community have an understanding, much like we did last week with what is the historical probability of a rate cutting cycle. Well, what is the historical probability of seasonality, not just in September, but I'm sure, over the next 4 months, I guarantee we'll be talking about the October lows from a seasonality perspective. I guarantee we'll be talking about the Santa Claus seasonality. And then I guarantee in December, we're going to be talking about, is Santa Claus going to come to town, or are we going to see that Santa Claus rally? And so seasonality, it becomes important because it becomes part of our language in this time period. And so I think it's important to understand. I think it's important to navigate, but I don't think it's important to anchor against, because if you were thinking about seasonality, we'll take a look at the seasonality chart of the S&P 500. It's not always consistent, and it's very inconsistent, quite frankly, but it does give you an understanding of typical environments throughout the year.
Yeah, and most months tend to favor the bulls when you look through market history. When you look through historic market history, when you look at market history over the last 10 years, over the last 20 years, no matter how you parse it, no matter how you try to dissect it, most months tend to favor the bulls. September's not one of them.
Nope.
Not one of them. But talk about Santa Claus. If you're listening to this, you don't see the joyous stock market trading Santa Claus that Matt has on the screen right now. It's worth checking the YouTube video at tackletrading.com.
He's just making some trades. That's all. He's just.
I was not prepared for Trader Santa.
He's just getting ready. That's all. He's just getting ready. Just Santa's getting ready. That's it. What is market seasonality? Seasonality, and I'm just going to kind of read the slide so that you can get the definition. Market seasonality refers to the tendency of financial markets to exhibit certain trends at specific times of the year, driven by reoccurring events and patterns. And these patterns are influenced by factors like investor behavior, economic cycles, seasonal events such as holidays and earnings season. Now, seasonality is based on, we see certain patterns and patterns that form trends throughout certain time periods in the marketplace, right? We get a few of the different examples. For example, you have the Santa Claus rally, which is two parts. One, the actual definition of the Santa Claus rally is the last week of December and the first 2 trading days of January. And that is a Santa Claus rally we typically do see, right? And it's driven a lot of times through, the tax conversation at the end of the year bonuses, light trading volumes. That's probably the number one reason we see a little bit of a bigger bump up is due to light trading volumes. You also have the January effect, which you typically see a relative outperformance in January of small caps relative to mega cap stocks. January effect can also be seen as how January goes, typically the rest of the year goes. You have probably the most, I would say the most stated one would be the Santa Claus rally, would be the one that's most talked about. I would say sell in May and go away is also a very
people love
one.
talking about that.
It is a very close one to the Santa Claus rally. And the sell in May is a historical trend where basically from May to October, which includes the September negative seasonality, it's just sell in May, go away, come back in October, and get ready for the Santa Claus rally, basically.
I find sell in May and go away to be the least useful out of all of them, because I'm like, what am I supposed to tactically do with that?
Well,
am I supposed,
it's not even, and by the way, it's not accurate.
Yeah, and I'm like, all right, so I'm just supposed to take 6 months off, go to cash, or like what? Like, there's no
May
trading it's
I did a
dumb.
seasonality thing for the newsletter just recently, and I want to say May was like the sixth best performing month for the stock market in the last 10 years or so. No, again, some of these are cliches for a reason, and some of them are cliches because they just have they take on a mentality in the marketplace. Some are a little bit more important than others, obviously. Now, when it comes to what we're talking about in terms of September seasonality, the September seasonality is based on the fact that September is historically the worst month in the marketplace. And that's the case whether you're looking at 5 years, 10 years, 20 years, 50 years, 150 years. I don't care what the data is, you're going to see September, or the time frame of the data, September is going to be the worst performing month in the marketplace. Now, oftentimes, from a seasonality perspective, oftentimes it just becomes something we talk about in the marketplace. But in September itself, Mark, do you think there's a reason September is historically the worst month, or is it just random?
And I've heard some really smart people argue this, and I've heard some really dumb people argue this. I have never came to a specific conclusion. The only thing that becomes important to me is self-fulfilling prophecy a little bit,
Mm-hmm.
right? Where people expect something to happen and thus they start acting upon it because they expect it to happen, right? I
Mm-hmm.
think, part of that, like in Santa Claus season, I think in November and December, I think there's a part of that is in play, right? People expect a good end of the year, especially if the whole year's been positive, right?
Mm-hmm.
It's like year's been positive. Let's go. I think there's some self fulfilling prophecy there. And so that's the best I've came is that it's just started. I don't have a massive take here,
See,
other than I
and
worry
I
about
think the
self
data is
fulfilling.
thrown off because there's a couple data points that are extremely negative for September. For
Mhm.
example, September 2008 was a 30% drop in price in
Which had
September.
almost nothing to do with seasonality.
No, it had everything to do with Lehman Brothers just decided to declare bankruptcy in September of that year. Like, had nothing to do with anything other than that's when.
Could have just as easily been October or August. It
Very
just
easily,
happened.
very
You know?
easily, and so there's moments in time that you can point to that September and the early part of October, the data is a little bit off because of those massive volatility. But whether it's a self-fulfilling prophecy, whether it's a couple data points that are just making the overall data worse, Mark, the reality is September is the worst month in the marketplace historically. There is no doubt about that. There's not even a debate about that. Like I said, September from any time frame, whether you're talking the last 10 years, 20 years, the last 100 years, the last 150 years, it does not matter. September is absolutely the worst month in the marketplace. Now, when you look at this from an overall trending perspective, and TradingView has some seasonality charts that are really, really good. And also when you look at when you use Thinkorswim, you can also adjust this to a seasonality chart as well. So when you're in Thinkorswim and you want to adjust it to a seasonality chart, you right click on the chart, you go down to style, and you come up to where it says chart mode, and then you just scroll over to where it says seasonality. And then what you can do is you can look at it from a seasonality charting perspective, and I'm just going to look at it from a weekly perspective. And so I'm going to say, okay, let me pull up 20 years of data. Let me see it on a weekly chart to get the relative performance here. Now, when you're looking at seasonality itself for the S&P 500, let me get this, and I need to scale this for a second. There we go, so we can see it a little bit better. All right, when you're looking at seasonality in the marketplace, you see over the course of the last 20 years, you can chart this on Thinkorswim from a line graph perspective. And in the month of January, typically good. In the month of February, from mid-February to mid-March, we typically see a pullback. From in mid-June, we typically see a pullback. In September, we typically see the biggest pullback. And so in seasonality, you see a little bit of negativity in February and March. You see a little bit of negativity in the summer season. And then you see a typical sell-off in September before you start bottoming towards the end of September. And then obviously you have a better month in October, and then November, I think.
Sell in May and go away has been terrible advice.
Sell in May and go away is the dumbest cliche in the marketplace. It truly is. Sell
So over
May,
the last 20 years.
I'm not kidding. This is the last 20 years. Sell in May and go away. If you sell the 1st of May and you're right for the first 3 trading sessions, and then you're wrong for the rest of the 5 months. Like it's the most ridiculous of all the cliches, because it doesn't have any historical data to it at all. But when you look at September does have historical data where you do see that pullback. Now, you can also see it from a percentage perspective. September typically does see it from a overall perspective of I want to say, let me use price as a percentage here. And let me come back to the SPY. So as you can see, from the top of September, from the very beginning of September to the bottom, we have a tendency to go from 5.2% up in the year down to about 3% up in the year. So you see a pretty negative reaction.
I mean, that's a noticeable clip.
It's a 1.5% to 1.5% clip in September is what. Now, from the top to the trough, that is, Mark. From the top to the trough, where it ends, you typically see about 1.3%. Okay, so it does have a greater than a 1% negative probability going into September. Now, again, historically, what do we see? We see a lot of Septembers where there's nothing occur here. A lot of times September is kind of one of those bad months where we do have to take into account 9/11 happened in September with a 10% drop in price following 9/11. You had obviously Lehman Brothers in 2008 go in September. I'm off the top of my head, I'm certain I could think of more data points. I believe the trade war was started in September, for example. I could go off a little bit more, but there's some important data points in September, and we certainly do see that from a seasonality perspective with the bump down in September. However, the one thing I'll say to this, and then I want to get your take on seasonality here, Mark, is seasonality, I find it very difficult to apply seasonality in terms of the end-all be-all type of analysis. I take it into account. I'm fully aware of September's typical price response, but I have a difficult time applying it in the real time because of the environments being so different. And Mark, as a macro top-down analyst type guy, I'm very familiar with those macro differences, and so it's difficult for me to anchor too much against seasonality when it's really an environment issue more than absolutely anything else. For example, seasonality also has a negative read in February through the beginning of March. This year, did we see that? No, we did not. No, we did not. Seasonality also has positivity from March through the beginning of May. Did we see that this year? No, we did not. We actually saw a pullback this year. As you can see on the blue line is what the actual price did. For example, seasonality from July through August. Well, what did we see this year? We saw a violent sell-off this year. Well, typically what do we see? We see a rally. And so I just find it very difficult to get overtly concerned about the September seasonality when, historically speaking, a pullback occurs in February through early March, and we saw one in April of this year. Historically, the pullback happens in September, and this year we got it in July and August. So I kind of feel like we already got the pullback in the analysis, and I just feel like the technical conversation is the most important. But talk me off this, because
this is why this year I'm applying a seasonality playbook in advance, which I almost never do. Yeah. Right. So this is, once again, I have very bullish vibes for the next couple and a half weeks. But then we're coming into September OPEX. Price can always act funny around any OPEX that you do. I always like to give it a couple of days anyways. But more importantly, I think you have the Fed event where you have a potential buy the rumor, sell the news event on the Fed, right there, mid-September, right as seasonality. You also will have, we will only be a few weeks away from the election, right?
Mhm.
And so buy the rumor, sell the news could certainly be type of the thing. You have election jitters or not. Now, when you just combine them with what could be a self fulfilling, oh, it's September seasonality, let's look for an excuse to dip. If we're at a rally point heading into that point, because I'm assuming A happens, you get a rally, broad based rally heading into that point, it feels like a natural time to take some profit off the table, scale back as you head into a potential buy the rumor, sell the news event, as you head into self reinforcing seasonality, as you head into people looking for an excuse to maybe doing the same thing ahead of the election, right? I just think this particular time, you have a confluence of factors that could play out around a time where markets have liked to take a break anyways, right? And if I'm wrong, I miss out on a round of trades. If I'm right, I get a better price to buy the dip at.
Well,
Right? So,
can I just draw what you described? Is that okay
yeah,
if I draw what you just described?
yep.
Because I let me just say I could definitely see that as kind of the base case. Market
So
breaks
draw what
out.
I described.
Okay, I'm going to draw what you described. This is what you just described. You described a rally going into the Fed, correct?
Yes,
Okay,
that's what I think will happen.
rally going into the Fed. Then you described a pullback post Fed, correct?
Hmm.
And then you described after the Fed. Then you described a. I got this. There we go. Hold on. Let me get a different color here. So you first described a rally into the Fed, correct?
Yes,
Okay. Then you described a pullback or a profit taking session post Fed, correct?
correct,
And then you described a rally, correct?
correct.
You just described the bullish uptrend of seasonality. That's all you
Yeah,
described.
it's not. I'm not like
the trend.
and I don't know how far a rally goes. I don't know how far a deep
But that's
pullback
what
goes.
but that's what you described
But
was a
that's what
bullish
I
trend.
described, right? That's what I described. So, and
And
then
honestly, I would say that's chalk. I think we do break out. I think we do set a higher threshold of resistance, and I think we would pull back. And I would also describe that as having nothing to do with seasonality.
yeah, and the only thing I worry about with seasonality is that you do have some self reinforcing because this is going to get a lot of dialogue. I've already seen Goldman Sachs talking about it, right? And so I think this could have a lot of dialogue. We'll see. We'll see how it plays
Is
out.
that
But I
why
am.
Wall Street gobbled up the price action so aggressively on Friday, the last Friday of August, so they get
Mhm.
ready for the selling behavior? See, I just find seasonality, and again, I don't want to throw too much cold water on seasonality because I think it's an important conversation, but I don't think you anchor against it. I think you understand seasonality in the back of your mind to understand that it is a negative tailwind for the stock market this month. There's no doubt. If there's not positive news, the path of least resistance is going to be down. I think you could definitely have that opinion. But to say, let me buy, for example, craziness. Let me go buy some put options to protect my long-term retirement account.
Oh,
Because
I will
historically,
not be
seasonality plays
playing the
out.
downside during this stretch. Matt, I'm not going to turn bearish till I see economic data that tells me to turn bearish. It is really that simple.
If I turn bearish, it's going to be on a violation of 550 and
Yeah,
on increasing volume is what it's going to be on.
yeah,
But
like it is like if you are going to go out there and bet any seasonality on the bear, say good luck to you. Like right, like
again, I think it's one of a few data points that's important to navigate this month. I don't want to come across as it's not important because it is important. But is seasonality more important than what Jay Powell says in the press conference on the cut day? Is seasonality more important than the print that comes on labor market this week? Is seasonality more important than Broadcom's earnings report, which is the number one earnings report this week? I would say the market's going to go based on the data that comes through the market over the next week to 2 weeks, not just randomly because we're flipping the calendar going into September. It plays a role in my head if volatility starts to pick up. because if volatility
So
starts
you think
to pick
that's
up,
where like self-enforcing,
yes, that's where the
like, oh, it's
self-fulfilling
seasonality, and
prophecy can
it
play
kind of
out.
puts some fuel on
Yes.
the fire?
If the data starts to sour and you start to see violations of support, you could
Right, makes
easily see
sense.
a pickup in volatility at that point. But I also think to the active trader side of the equation, we're going to see that in the individual candles and the volatility of the moment. I think to Mom and Pa America, who doesn't navigate the market on a day in, day out basis, I don't think they should get too caught up in the concern of seasonality.
Well, if they're not following the market on a daily basis, they shouldn't get caught up in much, to be perfect.
Listen, Twitter gets you caught up in a few things very quickly.
Listen, I don't follow Twitter like actively. Do they talk about these type of things on Twitter? Like,
It
does
depends
it?
on what you follow. I get a lot of it because I'm active on Twitter and I engage with other accounts such as the finance accounts, and so Twitter likes to spew out a lot of potential information for you on the For You page. So yeah, I do get a lot of the randomness of people's opinions of the economic analysis, and you see a lot of influencers trying to come out and push these types of conversations like they're more important than they are. Like, for example, when the Psalm rule got triggered a few weeks ago, nobody's talking about it right now, but there for about 3 days, everybody was a genius on that one on Twitter. So no, it does happen, but it doesn't, like, in terms of the algorithm really works with what you participate in, right? And so if you participate in a lot of that conversation, you're going to get a lot of the randomness of that conversation as well.
Yeah, that's funny to me. Like the Psalm rule. Like, seriously, we could do a special podcast on the lunacy that occurred for 1 week in the market on the Psalm rule.
When the labor comes in at let's say the labor misses and comes in at 4.1 this week, does that mean the Psalm rule is no longer impacted? Or the inverted yield curve? We've been inverted for years, but okay.
Yeah. All right. Listen, I've enjoyed this conversation. Hopefully you've enjoyed listening, Matt. Listen, I'd like just to tell you, like, we have these type of conversations every day in the Traders Lounge, in depth, where we're looking at actionable things to do. It is just a fantastic place to hang out, and I think we do a great job for our pro members. Come join us on that Traders Lounge. Come check out the newsletter that Matt referenced here. Come attend the live classes. Go to tackletrading.com. Sign up for that 15-day free trial. Come see what it's all about. Matt, give us some final words. Seasonally send us off.
Yeah, thank you so much for watching Trading Justice 594. If you're listening to it, thank you so much for being the best part of our community at Trading Justice and Tackle Trading, and we appreciate you guys. And so I hope everybody has a wonderful, wonderful week.